We are adding attendees here coming online, so I want to say hello and welcome to our webinar today. I'm Brad Lubin, Associate Professor and Extension Policy Specialist with the University of Nebraska-Lincoln's Department of Agricultural Economics. Today is part of our Center for Ag Profitability's weekly webinar series, which usually happens every Thursday at noon Central. You can always check out the full schedule on our website. You can also find archived versions of previous webinars on the same website at cap.unl.edu. Today, we're talking about economic conditions in agriculture and recognizing that they've rebounded dramatically over the past 2 years, alongside a sharp recovery in broader economic conditions. Ag commodity prices have remained high, farmland values have set new records, and farm financial conditions are considerably stronger than before the pandemic. While factors specific to the pandemic may continue to affect agriculture conditions to varying degrees, the path forward for agriculture will depend significantly on these broader economic forces. Joining us today to discuss how these forces are likely to shape the outlook for agriculture is Nathan Kauffman, the Omaha branch executive and vice president and economist with the Federal Reserve Bank of Kansas City. It's a special opportunity to invite Nathan back to our webinar series because this webinar series, in fact, started a little over 2 years ago in the depths of the COVID pandemic and the original sort of supply chain and consumer demand shocks related to COVID. Nathan joined us then in our very first webinar and as part of that series, and we're pleased to have him back again today. Nathan, a couple years ago, it was COVID shocks and consumer demand shocks and supply chain shocks. This year, amongst other things, it's war in Ukraine. There's always a new shock or at least a new challenge, and we look forward to your discussion of the topics. One more note about Nathan to note in his role as the bank's lead economist and representative in the state of Nebraska. Nathan provides strategic directions and oversights for the Omaha branch, which is involving regional research and economic outreach through the state. He serves on the Kansas City Fed's as the Kansas City Fed's principal expert in agricultural economics and is a leading voice in the agricultural economy throughout the 7 states of the 10th Federal Reserve District and the broader Federal Reserve System. So Nathan joined the Federal Reserve in 2012 after receiving his PhD at Iowa State University. That's Nathan's background. As I said, we're going to talk about economics and the path ahead. So Nathan, thank you for joining us. Welcome. We look forward to your presentation and discussion.
Well, thanks, Brad. Thanks for the introduction and again for the opportunity to join today. I think you're right that a lot has happened the last 2 years that we could spend a fair amount of time on just discussing those developments of 2 years. It certainly has been a pretty uncertain and volatile time, and I think it's important to host venues like this just to be able to share information. It's a nice way to be able to do this virtually, of course. Look forward to being able to interact with people in person, but we also look forward to questions and discussion. So again, appreciate the chance to join and share a few things of what we're seeing with respect to conditions on behalf of the Kansas City Fed and maybe more generally the Federal Reserve. Just a level set before I get started here also for this afternoon. Some of you may have participated in these sessions in the past, but for anyone who has not, just a quick word about the Kansas City Fed and why we participate in things like this. The region that we cover, Brad, as you noted, is 7 states in the middle of the country, which has a pretty significant concentration in agriculture. We've got a lot of financial institutions that are connected to developments in ag, and so it's an industry that's always been important for us to monitor. More broadly within the Federal Reserve, it's important to include those perspectives for policy discussions. So that's been something that has been a focus for me specifically, but more broadly for our Omaha branch and maybe even more broadly for the Kansas City Fed. So pleased to be able to have the partnership that we've had with UNL and to share a few thoughts of what we've been seeing here most recently. I will get started with a presentation here then for this afternoon, and just to keep things simple, I am going to shut off my video for the moment as I work through some slides and look forward to some questions at the end, and we'll turn the video back on then. So what I'd like to be able to share for this afternoon is a high-level update on what we're seeing with respect to agricultural economic conditions. And as Brad noted, there's a lot of different threads that we could try to weave into the discussion for this afternoon, ranging from what we experienced during the pandemic, obviously the year and a half that ensued following that, but then also spending time recognizing the significance of the war. My aim for right now is really to keep those things at, like I said, a pretty high level and try to paint an overarching narrative that will hopefully be useful for people thinking about questions that might be more specific. And I'm definitely looking forward to questions that people may have. I'll leave plenty of time for that. We appreciate the questions in part because it helps alert us to some things that we maybe haven't been mindful of. We try to track things from a number of places, but recognize that it's sometimes to get others' perspectives in terms of what you're seeing, especially in some of the developments of the past 2 years. So just to get started here with a couple of brief comments and highlights as to how I would see things evolving with respect to agriculture. As Brad noted in the introduction, it does appear to be that conditions in agriculture have rebounded sharply since 2020. And I'll note here that much of this was even in advance of the crisis in Ukraine. That has, of course, elevated a sense of concern and uncertainty, and I'll talk about that a little bit. But the thing to note here is specifically that commodity prices have surged even further in recent months. But it's not just commodity prices, it is also the costs of key inputs, and I'll talk about some of it as well. As a takeaway, I would still indicate that economic conditions in agriculture seem likely to remain strong throughout the rest of this year. But there are some signs that we're tracking, I would say, even in just the past couple of months, that might give us a sense of pause that there could be some heightened risks in the months ahead. And as we look at 2023, I think those sorts of things will be important. Some of this may be coming on the heels of the war in Ukraine, but some of it even just maybe more generally building on developments that would have begun to evolve even in the previous couple of years. So just as a couple of quick themes here before we get started. So just as a little bit of context, I won't spend a lot of time talking about conditions prior to the pandemic, and I won't even spend a lot of time talking about conditions during the pandemic, in part because we could devote the better part of the day to trying to determine what all of those implications might have been. Really, the main thing that I want to start with here for context, because I think it is important to start prior to the pandemic, given the circumstances then and the rapid changes that ensued, is to recognize that we spent the better part of 6 or 7 years prior to the pandemic in an environment that we might have described as subdued or in the midst of a downturn. And that's what I want to illustrate with this first slide, this first chart, is to recognize that the years between 2010 and 2013 were exceptionally strong. A lot of farmers, not just in Nebraska, but across the Midwest and even more broadly, may have indicated that those were some of the best years in agriculture that were experienced for many years. You can see, for example, that coincided with a significant increase in agricultural commodity prices. And that was a large driver of the strong increase in incomes that we saw during those years. The years that followed were more concerning. We saw about a 50% drop in farm income from 2013 to 2016. You can see that coincided with a pretty sharp decline in agricultural commodity prices. The point that I want to make on this slide is not so much what happened from 2010 to 2013 or 2016, but is to recognize largely what some expectations may have been for the long term prior to the pandemic, which is to suggest that there wasn't something specific at the beginning of 2020 that was causing a lot of people to think that the following 5 to 10 years necessarily would look dramatically different. So the longer term projections for agriculture at the beginning of 2020, as you can kind of see with the dotted blue line here showing commodity prices, was generally for an expectation that the relatively subdued incomes or the downturn that we had been in the midst of was likely to continue. So this was in advance of the pandemic and in advance of any of the disruption that we've observed for the past 2 years. So again, I don't want to belabor this chart, but rather as context to say, this was 6 to 7 years in the making, coming off of a downturn from 2010 to 2013, with not a lot of expectations that there might be something substantially different going through 2021 and 2022. So that was my one slide to show some context leading up to the pandemic, but now I'm gonna move forward and really kind of just skip a lot of the turmoil of the pandemic, which I think these sessions have done a really good job of covering for the past couple of years. But to fast forward and suggest where we see things today and try to convince all of you that what we have in fact seen has been a dramatic recovery in economic conditions. And so I'll do that in a number of different places. And my hope on this slide is to be able to offer a couple of points that give some of the proof to this, or at least some of the evidence of why we've seen conditions recover and the scale to which we've seen them recover, not to suggest that this is where things will stay, but rather the dramatic turnaround that we have observed. So the first that I mentioned on the previous slide is farm income. And I will note that this slide is showing all of these conditions and indicators relative to the 2010 to 2014 time period, which of course was very strong years in agriculture. And so what you will notice on this slide is a period of time from 2015 to 2019 in dark blue that was dramatically weaker than those conditions in 2010 to 2014. All of those bars for the farmland values is an exception that I'll get to, but most of these dark blue bars are less than 100, meaning that the conditions were generally worse than what they were during those good years from 2010 to 2014. In contrast, what you see is a pretty marked turnaround in light blue. And this is the most recent data that we have. Some of this will come from national data. Some of it comes from data that we collect at the Federal Reserve based on surveys. Some is from more recent information that we have on commodity prices. But the general theme that you will see on this slide is that conditions in the first quarter of 2022 are not only substantially better than what they were in those 5 years from 2015 to 2019, but that in many ways they're even better than conditions from 2010 to 2014, which again, to reiterate, were exceptional years in agriculture. So when we look at farm income, for example, farm income in the first quarter for 2022, and this is based on information specific to the Kansas City Fed region, which includes Nebraska, is about 12% higher than those years from 2010 to 2014. Commodity prices on average are substantially stronger than what they would have been during those 5 years from 2010 to 2014. There have been a lot of government payments from 2018 through 2020 that provided substantial support for agriculture. We know that that contributed to farm income. However, what I'll comment on in this middle bar is the fact that exports have been exceptionally strong in 2022. This started really the last half of 2020. It continued through 2021 and are in fact quite a bit stronger than where we were in 2010 to 2014. So it's not just a story about government payments providing income support. It's not just a story about COVID-related developments, reducing available supplies or drought, and I'll touch on that, causing prices to increase. It is a reflection of a significant rebound in global demand for agricultural products that has supported prices. The next that you see on this slide is farmland values. This has been a little bit of an anomaly in the sense that in some places where we saw weakness in the years leading up to the pandemic, we actually did not see a lot of weakness in farmland values. Some of you might be in areas that you say, that's not true. We saw land values come off by 30 to 40%, and I would say that's probably accurate. But when we look at things in an aggregate sense, we did not see large declines in land values that compared with the increases that we would have seen in previous years. So that was from 2015 to 2019, but we have continued to see rapid increases in land values, and I'll talk a little bit more about that later. The last one that I'm showing on this slide is a measure that we at the Kansas City Fed actually think about quite often. And we show this as farm loan repayment rates. And the reason that we show this and think about this is because the directionality of farm loan repayment rates says a lot about the extent to which there may be significant financial stress in agriculture or the ability of farm operations to continue to invest and continue to innovate and make progress in recognition of underlying strength. And what you can see on this particular indicator is a pretty sharp decline in the 5 years from 2015 to 2019, in stark contrast to where we would have been seeing things in the previous 5 years. But with the additional incomes, the rise in commodity prices, the support coming from land values, the overall strength in the farm economy, those loan repayment rates have been strong the last year and a half. There's been a replenishment of working capital that had been depleted prior to the pandemic. And so you see that number not just higher today, showing strength relative to last year, but it's been higher for the past year and a half in the wake of the pandemic. Okay, so the next slide that I want to discuss is really kind of a recognition of where things had been right before the invasion of Ukraine, because I think that this is important because of the context going into the war, but then talking about what some of the implications have been in the wake of the war. And for this slide, this is just showing a very broad index of commodity prices for some of the commodities that would be of most importance for our region: wheat, soybeans, and corn on the crop side, and then cattle as a specific indicator on livestock. I've again indexed this chart to be relative to 2010 to 2014, and I keep referencing that period because those were really strong years in agriculture. And so anything that is lower than zero on this slide is with the caveat that it's being compared with pretty strong years in agriculture, and anything that's higher than zero is to reiterate that those points are actually higher than really good years in agriculture. And so what you see, first of all, is, to reiterate the point I made earlier, in the second quarter of 2020, this was maybe the depth of the crisis in a lot of ways. It was really at as economic conditions associated with the pandemic were intensifying, we were seeing sharp declines in commodity prices. In the case of corn, prices were 50% less than they were during the good years in agriculture. But maybe more importantly, prices were actually lower at that time than what they would have been immediately prior to the pandemic. So their conditions were already a bit concerning going into the pandemic. They got worse. And there were a lot of questions about how much worse would they get. By a year later, so the third data point that you'll see on this chart, by the second quarter of 2021, many of those conditions had rebounded. So it was not, again, it was not just the support that was coming from government payments and the CARES Act and other things in 2020. It was a recovery in commodity prices and incomes at a time when, yes, input costs were rising, but maybe not fully by then. And so incomes were strong in 2021. As we move forward, and the last data point on this chart, again, I specifically chose February 1st to be a couple of weeks in advance of the invasion of Ukraine. Prices of all of these commodities that, again, are major commodities, not just for Nebraska, not just for our region, but really pretty good bellwether indicators for agriculture more broadly in the country, were strong in advance of the invasion. Wheat prices 25% higher, 25% higher than good years in agriculture. Corn prices, soybean prices were double-digit percentage points higher than what they were during 2010 to 2014. So again, we had seen conditions begin to recover in advance of the invasion. Input costs were rising and it was a growing concern. But this is to underscore how strong conditions were going through the beginning of 2022 in advance of the war. All of that is to then segue into things that we've maybe been observing in more recent months, and to recognize that prices have increased even further, not just for commodity prices, but again, for input costs. And I will continue to highlight that point as a concern of something that we're going to want to be mindful of, not just for profit margins, but probably more specifically for profit margins looking at 2023, which, as many of you might know, will be a farm bill negotiation year. So as we look at the chart on the left-hand side here, what you can see is that commodity prices have continued to rise through the early part of 2022, and recognizing the war, perhaps at an even faster clip than what they had been in the months prior. You can see the same for corn prices as a specific example, the sharp increase in prices that happened at the end of 2020, the first couple of months here in 2022, taking into account the early months of the war. The point that I want to make on this left-hand side of the chart of the slide is the dotted line, which is representing future prices for corn. And this is just a way to say that prices have been high, they've been rising, and futures markets would indicate that they're likely to remain high based on the information that markets would assess on all of the things connected to the war, connected to the pandemic, connected to drought, that I'll talk about in a second. Prices are likely to remain high even by the end of the year. As you look at, for example, a December futures price contract, it's quite a bit higher than where we were a year ago. and it's a lot higher than where we were prior to the pandemic. Prices are not the only thing that matter, and we know that. So when we look at input costs, we have to recognize that there are broad increases in input costs, and inflation has been a primary concern, not just in agriculture, but more broadly in the economy. This green line that you see on input costs probably understates the significant increases in costs for specific categories, and maybe even the availability of those categories. When producers are thinking about fertilizer or thinking about chemicals in general, thinking about diesel costs and other things, they're more significant in terms of increases than what's showing up in this green line. This just captures an aggregate measure for the sector. The point that I want to make with that green line is that we started to see those increases in 2021, and the pace of those increases has not slowed. So we still are seeing substantial increases. They're much higher than a year ago. A question going forward will be, if we do not see ongoing and significant increases in commodity prices, but we do continue to see increases in input cost, what will that mean for profit margins in 2023? So I'll keep coming back to that point. The chart on the right is another way of underscoring the likelihood that crop prices are likely to remain high. And that is to suggest that in the region that we cover in the Kansas City Fed, which again does obviously include Nebraska, the severity of drought that we have in our region is notable. And I tried to show a picture of this in simple form, of course, pulling from the great work that's done at UNL with respect to monitoring the drought, by showing what we observed in terms of drought from 2017 to 2021 on average in the dark blue bar. And this would simply show the share of land in drought that's categorized as either severe or worse. You can see in the states that we cover, with the exception of Missouri, that all of the other 6 states that we cover would have more severe drought now than what there was on average from 2017 to 2021. And quite a bit more severe even than a year ago, especially in the case of Nebraska, but also Kansas, Oklahoma, both of those states in particular being significant wheat producing areas. And of course, that being important when we think about the developments in Ukraine. The next point that I want to make here, kind of to again continue the theme of recognizing the strong increases in the financial position of the ag sector in terms of the economics, but also the costs, is to recognize the most recent trends that we've been observing with respect to farmland values and cash rents. We highlight these 2 indicators for a couple of different reasons. One is because the value of land is a pretty good indicator for the overall financial position of the industry. And you can see that in this chart. I've made a lot of reference to the years from 2010 to 2014, and that obviously coincided with large increases in land values, double-digit and 20+% increases in land values at that time. We then saw those land values come off from their highs and decline by 5 to 10% on average during those years from 2015 to 2019. They began to stabilize alongside some of the government support programs that provided additional support for incomes. But most recently, we're actually looking at, again, similar to that period from 2010 to 2014, a 20 to 25% year-over-year increase in land values. So this is to suggest that from a financial perspective, land being a pretty good indicator, agriculture has been in a strong point. But the other part of this, and I'll get to this in a second, is to recognize the importance of land as it relates to a financial resource for farm operations to draw on when it comes to thinking about lending and when it comes to thinking about leverage and maybe the exposure of the industry to changes based on what that value might be. So we have continued to see in the most recent data that we've collected, which would be for the first quarter of 2022, a 25% increase in land. This probably also understates the fact that it's not just increases from a year ago. We actually saw a 5% increase from the fourth quarter of 2021 to the first quarter of 2022, which illustrates that in spite of all of the other concerns that we've been seeing for the first quarter of 2022, which includes inflation, it includes prospects of higher interest rates, it includes the war, is that we've continued to see some of those land values rise. At the same time, we're seeing cash rents begin to increase at a more notable pace. It's not uncommon to see land values rise more quickly and sooner than cash rents, but eventually cash rents start to track the changes that we see in land values. And of course, that's an easy thing to see on this chart, that the general shape of the lines is pretty similar. So whereas we saw significant increases in land values in 2021, cash rents were not rising at the same pace. We are starting to see cash rents for farmland rising more rapidly in recognition of some of the strong gains in land values. I will say this is a similar phenomenon of what we see outside of agriculture in the housing market. Residential house prices have been rising at a strong clip since mid-2020, and initially rents for some of those properties were not rising at as significant a pace. We are starting to see more significant increases there too. So again, land values matter a lot for the financial position of the sector, and it's worth reminding, I think, everyone here that we had been in the midst of concerns with respect to the financial position in agriculture prior to the pandemic. So what you see in the light blue line is a longer time series, which is to say that farm loan repayment rates were declining not just in 1 year, but for multiple consecutive years. There was some concern about financial stress growing. There was concern about bankruptcies prior to the pandemic, and a number of other things that was building on the momentum of the previous years. You can see in that light blue line, though, that repayment rates began to increase dramatically in 2021, but continued to increase again in the first quarter of 2022. So as we look at the strength in the sector for 2022, I go back to what I mentioned earlier. The sector seems to be in a pretty good place for 2022, in spite of all of the risks, but I will end with, reminding what the risks might be in 2023. The dark blue line in this picture is really just another way of saying the same thing, that leverage in the industry has also declined. There were concerns about rising leverage from 2016 to 2019, and you can see this as a ratio of debt to income, for example, but that has since softened. And as we talk to our bankers, really for the past year and a half, what they've been saying is that there's actually been pretty limited demand for farm loans because the overall wealth of the industry generated from additional income and land values has meant that there has been more ability for farmers to self-finance. And so this measure also of leverage has been considerably less than what we would have seen in the years leading up to the pandemic. Okay, this is where I do want to shift now, though, having hopefully described some reasons why I think 2022 looks to be pretty strong, but I will end my presentation here with some things that I think we're going to want to be mindful of in terms of risks, and then look forward to questions. We are all aware of developments since the beginning of 2022. I've talked about the war as part of that, but the specific thing has been maybe with respect to inflation and concerns about the strength of broader economic activity. And here I don't necessarily mean in agriculture, I mean more broadly with respect to global economics. We know that there was a substantial rebound in economic activity across major developed economies across the globe, not just in the US in 2021. As you look at the dark blue bars, a growth rate of nearly 6% in the US was perhaps almost 3 times higher than the average pace of growth that we would have been experiencing in the 10-year expansion prior to the pandemic. It probably was not at a sustainable level. That was obviously a post-pandemic or a recovery from the depths of the pandemic in 2021. The point that I want to make on this slide, though, is 2 things. The first is to say that forecasts that were made in January for 2022, before the war and before the persistence of inflation, were already to suggest a softening from the growth rates that we observed in 2021, not just in the US, but China, the EU, the UK, Japan's a bit of an anomaly. But what you can see there is softening from the dark blue bars to the light blue. That's the first point. The second point that I want to make is really the changes that we have observed from the beginning of this year prior to the war, again, prior to what I will call as more persistence with inflation and maybe more changes with respect to interest rates, is a further softening of expectations for growth for 2022. So whereas in January an expectation of growth might have been in the 4% range, we're probably looking at something 3% or sub 3% for 2022 in the most recent forecast. It's even a further revision downward for the EU when you think about the dependence of the EU on commodities coming from Ukraine or even Russia, thinking about natural gas and energy as some examples. So the broad theme on this slide is simply to illustrate there have been more recent headwinds that will likely weigh on growth, and those will be things that we're going to want to consider with respect to the strength that's been provided for agricultural commodity markets at a time when inflation continues to run hot. That's a point that I want to turn to next here, and this is one that will be familiar with for most people, is to say that inflationary pressures have persisted. They've remained high. We're looking at inflation. There's a number of different indicators that we can look at with respect to inflation, but just a broad US CPI, Consumer Price Index, is to say that it's been around 8%. Well documented that this is the highest that we've experienced since the early 1980s and much higher than what the Fed's target would be. There have been many factors that are contributing to that inflation. The right-hand side of this slide is simply a way to describe what those categories are that are maybe most substantial. And shelter, vehicles, that's been well known, but food and energy being the other two that are contributing substantially to some of these measures of headline inflation that you see on the left-hand side. Lastly, what I'll mention here kind of is what this means with respect to the Federal Reserve and interest rates. As we think a lot about what we want to do with the information that we're gathering with respect to economic development, some of those implications is then to say what that means with interest rates. The higher inflationary pressures has meant a move toward interest rates to push back on some of those inflationary pressures, and the fact that maybe the economy's been in a strong position, but maybe so strong that it's generating more substantial inflation. This has led to some slight increases in interest rates, for example, that farmers would see by way of operating loans or real estate. It's worth reminding us, though, that they're still at low levels relative to even just the past couple of years, but especially low relative to where we would have been in 2018 and 2019. The Fed has put out some guidance, though, that there could be some further increases coming, and that's what the chart on the right is intended to convey. This chart simply shows expectations of interest rates at 3 different time periods. So at the end of 2020, again, keeping in mind the timing and the pandemic, it was maybe believed that interest rates in 2022 would still be pretty low. And you can see that in the second set of bars. As we started to see inflationary pressures persist by the end of 2021, the light blue bars, you can see that expectations for interest rates had begun to increase. Specifically here showing the federal funds rate, which is the rate that the Fed targets. By March of 2022, so the green bar, you can see that there's been further information that would suggest higher interest rates would be needed in 2022, even more so than what would have been believed by the end of 2021. And then as we look even further out in 2023 and 2024, a recognition that maybe those rates would need to be even higher than in 2022. So to add to some of the discussion about some emerging headwinds with respect to economic activity is simply to recognize that higher interest rates could also mean some additional challenges, but recognizing that those higher interest rates are ultimately in an effort to push back on inflation, which is too high, and recognizing that high inflation is problematic for all sorts of businesses, but especially in making decisions about how to think about the next several months or even the next couple of years. So let me end with just a couple of wrap-up thoughts, and then I look forward to questions. It goes without saying that there has been extreme uncertainty in commodity markets, especially with the war, but even in advance of the war coming out of the pandemic. But in spite of all of those uncertainties, the ag economy appears likely to still remain strong in 2022. And my evidence for that is to point to the indicators that I started with. Commodity prices are still high, profit margins are still there. Lending conditions are strong, credit quality is strong, land values are at record highs. All of that is to say that when we compare conditions prior to the pandemic, financial stress is substantially less than what it was in 2019. But it's not to suggest that everything is positive and could stay that way, because as I've mentioned earlier, there are some indicators that have begun to soften. We have started to see, for example, I didn't show it in this slide deck, some indications that loan demand is picking up. Sometimes that can be because there's more opportunities and profits are strong, but other times it means that producers are in a place where they require more financial assistance. If that is the case and we're seeing conditions soften, it's worth keeping in mind that we could see some softening in profit margins going into 2023. And again, reminding people that 2023 will also be a farm bill year in terms of negotiations, at a time when we're also looking at just potentially different conditions going forward amidst some of the more inflationary pressures and broader economic concerns that I mentioned. So I will stop there. I will also stop sharing my screen here and turn the camera back on, but we'll be glad to take any questions that people might have.
Nathan, thank you very much for the presentation and for the detail you provided. We do have a question to get started and a few more to come, I'm sure. So again, a reminder to the audience, please submit your questions via the Q&A feature at the bottom of your Zoom application there. We'll take questions as we have them here. First one is from a good friend of the East in Iowa. Ed asks that you highlighted 4 key areas that have some inflationary pressure. Is there any sector that is not struggling with inflationary pressure at the moment?
It's a great question, and it's one that we obviously spent a lot of time thinking about at the Fed. And what I will answer to that is that we have seen changes in the composition of inflation. In 2020, when there were shutdowns and business and production facilities of all sorts were shut down, but at the same time, lots of income being injected through various stimulus programs, there was a lot of spending power, but limited places to spend that money. And so people were spending it on goods and on a lot of goods, on products, on things that can be shipped, home renovation projects and otherwise. And so what we saw at that time was substantial increases in the inflation of goods. That was at a time when a lot of services were closed down. What we've begun to see more recently, though, is first a continuation of some of the inflation on the goods side of things, but more significant inflation on services. And so that's where you will see, for example, things like airlines and restaurants and other things. Obviously, food is part of restaurants, but so too are the services that are related to things like restaurants. So we're continuing to see inflationary pressures from some of the things that we had been seeing before, but adding to that a broader basket of things now that some of those services are operating that may not have. The important point is that many of those services segments are operating at reduced capacity. And the reason for that is largely because of it comes down to things of labor force. It comes down to some other things that happened during the pandemic. So the short answer to that question is that we're seeing inflationary pressures from a broad range of categories. There are some that are obviously much higher than others. Healthcare is an example of one where the inflationary pressures have not been as substantial. But part of the reason for that is because we think many people have probably put off things that may have been considered not necessarily optional, but voluntary things that may have been put off during the pandemic that could still be pent up demand going forward and maybe put more pressure on inflation. So there are some categories that have been more than others, but it is a pretty broad increase in inflation.
Nathan, if I could take the moderator's privilege here, I want to extend some discussion on inflation. If you think about labor markets and energy markets at the moment, we might see the inflationary pressure, potentially cost push type inflation as opposed to demand pull. But there was discussion as we were coming out of the pandemic as to whether this was transitory inflation or let's say maybe more longer term or so forth. Is there any sense to expect that inflationary pressure on labor and the challenges with labor supply are a temporal thing? Or is that a signal of a rebalancing labor sector that agriculture and other industries will have to adjust to?
Yeah, it's a great question. And I will say that we've sort of put to rest the idea of transitory inflation. And, part of the reason for that is that the word transitory in and of itself carries a sort of ambiguous meaning. When we were saying transitory at the Fed, in some ways what we meant is at some point, we think that those inflationary pressures would subside, but it didn't change the fact that the inflation that we were seeing for months on end was continuing to run high. I think that there still is maybe some possibility that what you see as a softening in inflation on a couple of points specifically. One is that it's maybe in some ways mathematically not possible that you could have a doubling of used car prices every year. At some point, the rate of inflation should subside as you see some amount of normalization, whatever that normalization looks like. The second part of that, though, is to suggest that if there are emerging headwinds in the economy, and if some of those headwinds are coupled with increases, for example, in interest rates, then what you would expect to see is businesses responding to those emerging headwinds. They may not be at some point as actively considering investment opportunities and spending opportunities or potentially even hiring decisions as they have been for the past year and a half when conditions have been exceptionally strong and stimulus from various programs was also a factor. On that end, as you see some of those stimulus programs wear off, that too would likely have an effect to pull back on some of the inflationary pressures. So I think that there are some places where we continue to see inflation running high, and it's been exacerbated by the war in Ukraine and those categories that we talked about. But there, where you would expect to see, as you would see in other economic cycles or business cycles, a pullback in prices if it's combined with a pullback in economic activity. The challenge for the Fed will be to how to weave that path in a way that really is best by pulling down inflation, but not causing maybe more concerns about economic growth.
Nathan, I think that spoke to another one of the questions we had on inflation, but let me sort of point to the question specifically and to help you reinforce that for our audience. To what degree does inflation, the current sort of expectations or statistics on inflation, to what degree does that reflect a healthy growth in the economy, the post-pandemic recovery, et cetera? To what degree do those inflation numbers really reflect healthy growth in the economy? And how does the Fed look at that as opposed to signals of growth, as opposed to signals of economic pressure?
Yeah, it's a good question, and it's one that at the Fed we have to think carefully about as trying to disentangle effects that might be associated with strong demand, which generally is a good thing for the economy, but recognizing supply constraints as being part of that too. I do think that there has been a substantial, call it post-pandemic recovery and demand growth, given the depths of the crisis from the pandemic as part of that, but perhaps even building on some of the stability of demand growth prior to the pandemic. That has to be combined, though, with the supply side of that equation, which is to say that a constrained economy cannot deliver goods and services at the same pace as what an economy might at full steam. And so if there are still supply constraints that might be coming from low unemployment, smaller numbers of people in the labor market, it might be coming from ongoing COVID disruptions, China being part of that, and what it's doing with respect to addressing its own COVID concerns, whether it might be the war in Ukraine as part of that. All of those things will be relevant, but somewhat separate from the underlying strength of demand. From the Fed's perspective, we have to recognize first that there's not a lot that monetary policy can do about some of those supply constraints. What the Fed's role is to say, given those trends that we're observing with respect to demand, with respect to supply, and what that ultimately leads to in terms of the persistence of inflation, what can the Fed do to make sure that prices are at a stable level that works best for the long term? And that's what you're seeing right now in terms of the reaction and adjustment in interest rates, is really trying to pull down inflation that's been running too hot. But to again reiterate, that inflation is coming from not just one place, it's coming from both the demand and supply side.
Mm-hmm. Nathan, let's move to a few specific sort of economic questions. Simple one first. Is this a good time or a bad time to buy farmland? Well, more specifically, what are the broad economic signals and what makes it attractive and what makes it potentially concerning at present?
Well, the first thing I will say is that, at least on a historical comparison, farmland values are pretty high. That's probably a statement of the obvious, and I've made that a couple times. So at the surface, it seems like prices are high. And based on the risks that I described to profit margins, one could imagine at least a scenario where those land values soften, or at least the growth in land values could soften. I think that's a plausible scenario. But I also think a plausible scenario is to recognize extreme shortages of food around the world right now, and recognizing that there is still a lot of uncertainty with respect to Ukraine, and that there could be a potential premium being offered for land that is maybe holding the best possibility for strong production. And the United States has been well positioned for that. And that's why I think that's part of the reason that you're seeing land values as strong as they are. It's important to remember that even before the war, inventories of a lot of the commodities that we're talking about, where there are concerns about food shortages in other parts of the world, were already quite low. The war just actually exacerbated some of those inventories, the tightness in those inventories. And so their land values are in part strong, obviously because commodity prices are strong, and commodity prices are strong because in part inventories are low. It could take a little while to rebuild those inventories. And so there are a lot of potential scenarios. I don't claim to have a forecast that suggests what land values are going to do. I think the headwinds that could come from lower profit margins are important to consider, but at the same time, the recognition of being in the middle of a crisis where there are concerns about food shortages is going to be a significant factor.
Nathan, to extend that further, I know it's more complex than the simple equation of returns divided by interest rates equals some value. But if inflationary pressure means that interest rates have moved up a bit and may move up a bit more, how quickly does that, or how substantially does that impact the outlook for farmland?
Yeah, so I mean, as a general comment, we would expect that higher interest rates should be something that puts a little bit of downward pressure on land values, but it's not as simple as just saying higher interest rates will lead to lower land values. There are a lot of other factors. One of those factors is to recognize, again, the level of interest rates. We are in a very different interest rate environment today than what we had in the early 1980s. That probably goes without saying for a lot of people observing today, but it's to underscore the fact that even though interest rates are rising, they haven't been rising at the same pace as the 80s and not at a level that we started in the 1980s, which means that there are other factors that are probably more important. Even though we are seeing increases in interest rates, it matters a lot what we see in terms of income prospects by way of commodity prices. It matters a lot what we see with respect to input costs and things like fertilizer and global availability of the commodities that we talked about. So I do think that over time, we would expect to see higher interest rates be a bit of a pullback on land values, but I also would suggest that there are a lot of other factors that could be even more important, and we'll want to pay attention to those.
Okay, thank you, Nathan. And an energy market question, and for those participating, the Kansas State Federal Reserve Bank has expertise in both agriculture and energy, amongst many other areas. Some of Nathan's colleagues down in the Oklahoma City branch particularly. But it's an energy question relating to ethanol and the E15 waiver that was announced earlier this spring. Some questions about what does that do to demand outlook and potential. And if I can bridge that, the talk or the potential growth in biodiesel and renewable diesel, particularly, what sort of expectations do the biofuels markets have in your economic outlook for agriculture?
Yeah, so I'll first address ethanol and then maybe the biodiesel question as a bit of a separate answer. And the first is to say that a lot of people, I'm sure, on this webinar would know that ethanol accounts for a large source of demand for corn specifically. And so the demand for corn translates directly into price support. And when demand for ethanol is strong, that of course leads to stronger prices. What we saw in the beginning months of the pandemic was a sharp decline in ethanol. And what we saw in the following year and a half was actually a pretty significant recovery. So even as you look at just demand for transportation fuel more generally, not just ethanol, that's been a pretty significant source of demand for the commodities that underlie it. So corn being one, oil being another. I think that it would be natural to expect that any amount of additional strength coming from demand for ethanol, even if it's at the margin, it might not be, again, the most important factor driving prices. I think things like exports and broader economic activity probably matter more. I do think that that's probably providing some support that you see coming by way of additional demand for corn. The second point that I'll answer, I guess, on biodiesel is to say that that has probably also been something that kind of like the rollout of the RFS many years ago that represented some potential new sources for demand for agriculture is probably something to keep in mind for the longer term too. So as we've been seeing the build out in biodiesel, I do think that, again, in the energy space, that represents some significant demand for agricultural products. It's not, and again, it's not just exports. So it's recognizing that there are underlying sources of demand for agricultural products. That could be exports, but it could also be the energy products that we're talking about, that I think put the forecasts and prospects for commodity prices on a bit of a different level than what we were prior to the pandemic. If you remember the first slide that I showed, there was a belief that prices were not going to be much different going through 2020 and 2021. The outlook for biodiesel and some other things may have altered that. We see a higher path for prices now than probably what we saw at the beginning of the pandemic. It might mean higher costs too, but there is some likelihood of stronger demand support there too.
Nathan, another question is about changes in federal farm policy, particularly with the CRP. We did see an announcement of some CRP changes just today, some early out opportunities for some expiring acreage. But it's also been a question of sort of balance of policy preferences to try and grow the CRP and for conservation reasons, and now some preferences or some calls to try and shrink the CRP to quickly respond to market signals. What sort of expectations, put on your policy hat, what sort of expectations do you have about the policy balance here and the fate of CRP?
So the first disclaimer that I'll make is that that's a policy arena that we typically don't delve too far into. We like to try to stay in our lane of monetary policy. But what I will say is, as an answer to it, is to recognize that the market incentives right now are pretty strong to grow crops. Corn, wheat, soybeans, all of those prices, as I mentioned, are extremely high. And again, that's being driven by the fact that supplies on a global scale are pretty short, and that being driven also by the war in Ukraine. So the market signals are already strong. That said, I know that there's probably a lot of efforts to consider what other tools might be available to address what in some places could potentially be a food crisis. A country like Egypt depends heavily on exports of wheat products coming out of Ukraine. And as the war continues there are some real questions about what some of those sorts of things might mean, even from a social and humanitarian perspective. So I know that there are efforts to think about how to stimulate more food production, but all of that will be in some ways, obviously a government and policy debate about how that affects the other decisions surrounding environmental priorities and other things like that. So it's not a deliberate attempt to dodge the question, but it's to suggest the market signals are strong, but those market signals will need to be weighed against whatever policy priorities might be in place that existed prior to these shortages in the pandemic.
Well, leave it to a policy economist to try and put a monetary economist on the spot, but your insight's valuable there. This one's more in your line there to look at a couple questions together. We've been dealing with a number of supply chain shocks at various facets, from the production and worker health to exporting and transportation, et cetera. Are there any positive trends on the supply chain side? And particularly a question relating to sort of the current labor shortages. How tough are they, particularly in agriculture, and what's the path forward for labor and for the broader supply chain?
It's interesting, the question on labor there, in part because we actually just hosted our annual ag symposium in Kansas City, focused on the topic of labor. And, there were a lot of things that came up there, but the core was to recognize that many of the labor shortages that are being experienced by other businesses are also being experienced by agriculture, and recognizing that there's maybe some solutions there to be thinking about, or implications at least for the long term. I think that we probably have seen some easing of supply chain constraints, or at least, if not an easing everywhere, that they're not necessarily getting worse at the same pace that they were, say, 6 to 12 months ago, or even back at the beginning of the pandemic. But we are still we are still in an environment where we do not have the same number of workers in the labor force that we would have had prior to the pandemic. There are still people sitting on the sidelines for a variety of reasons that we would need to see some return from the sidelines there to maybe normalize conditions in labor. A lot of businesses still facing pressure to increase wages because they're having a hard time finding workers. That would again be added to the concerns that we've already talked about with Ukraine. Those are maybe a little bit more industry specific and regionally linked. And what I mean by that is Germany is facing some significant challenges with respect to securing energy supplies that are on a different level than what we would be experiencing here in the US. It's not to suggest that we don't have some of those concerns too, but it's different in that way. I mentioned China and some of the things that it's working through with respect to COVID. So there still are supply chain disruptions that we've been experiencing that would be similar to those that we'd experienced before. A lot of those are tied to labor. But I would say that we've seen some gradual, at least if not improvement, easing of some of the ease some of the pressure on inflation.
Okay. Nathan, an energy market question. And I preface this by, if we've seen that the U.S. energy supply, production and demand balance has improved over the past couple decades, and we've moved closer to being energy independent, or at least sort of less dependent upon global supplies, theoretically that helps insulate us from global shocks. And yet U.S. energy prices are rising dramatically, just like the rest of the world. Are we insulated from those shocks? And if so, why is the price response here in the U.S.? Why does it look like it does across the rest of the globe? And how do we sort through that?
Yeah, my first response is to say that energy markets are still global. I'll put a plug in here for an article some colleagues of mine released a couple days ago to highlight some summary developments in commodity markets, not just agriculture, but also energy. And there's some actually striking similarities between the two that was released just a couple days ago. So first is to say that, yes, they're still global. In terms of why we're seeing some of those prices, the first thing I would say is the ongoing uncertainty about whatever economic factors might be driving investment decisions from energy companies. So even though the price of oil would suggest there's a pretty strong incentive to increase production, some of that investment is not necessarily happening at the pace that you might expect because there's still a lot of uncertainty. The uncertainty might come from the war in Ukraine. It might come from pandemic related uncertainty or the aftermath of it. It might come from policy uncertainty. But there has been some limiting factors to increasing investments. And then the other piece of that is again, to reiterate the labor piece. Labor shortages are in many ways affecting the production of a lot of different goods and services. And, we would talk to firms across the board that would say that labor is still a significant constraint. Cost pressures and those supply chain constraints are part of it too. So even if there are some incentives to increase production, and we see those incentives in a lot of different segments of our economy, it doesn't always lead to the kind of supply response that you might think that you could get because of the constraints that are there. And I think that those are some of the things that have been limiting a production response and thereby holding prices at a higher level than what we'd like to see maybe overall for inflation reasons.
And Nathan, you referenced the recent paper from the Fed. From the Kansas City Fed. I happen to have that paper open on my browser as well. So the link I have posted there in the chat section. So I encourage you to follow up there, those that are interested. We are approaching our 1 o'clock hour, but I have one or two questions left I'd like to get through. One is circling back to the land market. You noted that land continued to go up even during the more recent downturn in the U.S. commodity sector. Ag commodity sector. Land's really gone up in the last couple of years relative to where it was a decade ago. Has the mix of land buyers looked relatively constant over that time frame, or is it now a different mix that's continuing to drive prices higher?
Generally, I would say that the primary buyers of land still have been farmers. It's not true everywhere, and I'm sure that people depending on where you're living, would say that there's been some more investment interest, and I would probably agree with that too. Sometimes investors see land as a hedge against inflation or something that provides some insulation from other market disturbances. So I think that's true too. But a lot of the data that we would still have available would suggest that farmers are still perhaps the most active buyers.
Mhm. And Nathan, of course, for the topic and the expertise, the final question I have is back to an inflation question. So monetary economics here at heart. The inflationary pressure we've seen sort of post-COVID, the additional supply chain shocks, et cetera. For commodities, we've seen dramatic growth. On the non-commodity side, goods and services, we've seen growth. Is there an expectation, as you sort of alluded to, how long might we see inflationary pressure? When would we expect or hope to see it wane? And maybe a question of more relevance is, what sort of long run inflationary signal do we expect to get back to? We were operating maybe at sort of artificially or at least unnormal low inflationary levels, and now we're at peak levels. What do we get back to at some point?
Well, so my short answer to that question is to say that the Fed has a stated goal for inflation at 2%, which is substantially less than where we're at right now, but it's also higher than zero. Inflation that's too low can also be a problem, but obviously right now inflation is too high. I think as you look at forecasts, either from Fed officials or at market forecasts, you would see them generally expecting inflation to come down from the levels that it is right now, but perhaps even by the end of this year, still at a level that would be higher than the Fed's 2% goal, which is again, another way of saying that interest rates might continue to increase to push back against that. And, even into 2023, looking at inflation still being higher than 2%. So it could take some time to see those prices come off. But I do think that with inflation being a big part of the Fed's mandate, I think that generally the Fed's pretty committed to doing what's needed to pull down some of those inflationary pressures again toward the goal of 2% being a long run view.
The long run goal at 2%, yes, that though is higher than where we have spent a few years, right? So maybe we have been grown accustomed to too little inflation.
Yeah, we spent a lot of years before the pandemic wondering why inflation was not more than 1.5%, and the Fed has not really had to worry about inflation to the extent that it is now in years before the pandemic. So there's a lot of uncertainty about some of those long-term changes. It does seem that markets are generally expecting inflation to be higher even a year from now than what they might have indicated before the pandemic, looking a year out. So there are still reasons to think that some of that inflation can persist a bit, but generally the views would be that the actions being taken would move it in the right direction.
You bet. Nathan, thank you very much for your time. We had a great presentation and a great round of questions and discussion there to work through. So I thank you for being part of our webinar again today. My thanks to all of those who joined online, a substantial crowd today to join us online. Thank you for participating and being part of our webinar series. A reminder that this webinar will be available as a recording on our website, as are all previous webinars. You can find those at cap.unl.edu, where of course you can also find information about upcoming webinars, including a couple here, one ahead in early June on sustainable groundwater management in California, but its implications for Nebraska. So that's what's ahead. Our series continues next Thursday with that webinar. As you leave today, you'll have an opportunity to click a link, the final link in your chat box there. You can click a link and follow to a brief survey to help provide information on today's webinar and feedback, and provide information for our upcoming sessions as well. Again, thank you, Nathan, for joining us today. Thank you all for participating today, and have a good afternoon.
You're welcome. Thanks, Brad.